Hello students, welcome to the lecture on Standard Costing and Responsibility Accounting. After this lecture, you will be able to learn the following objectives. Understand standard costing and variance analysis, define responsibility accounting, explain quality costing, discuss standard cost variances. Now let us start with concept of cost controlling. Let us first see this video for better understanding of the topic.
Control costs is the process of effectively managing changes to the project budget, then integrating those changes across the entire project through the integrated change control process. It's important to understand that it is the project manager's responsibility to discourage unnecessary budget changes. It is also important to understand when changes are warranted that they be made in strict accordance with project cost change control processes, and that the established cost baseline remains intact. As with other baselines, rebaselining the budget is appropriate only in extreme situations. In cost control, the application of earned value analysis is a key tool used to measure project performance. Earned value analysis integrates cost, scope, and schedule to derive measurement values that accurately assess project progress to date, as well as forecasted future performance. Earned value analysis is performed using values such as planned value, earned value, and actual cost. Variances for cost, schedule, and overall budget completion can be calculated using earned value analysis. Indices such as Schedule Performance Index and Cost Performance Index show performance in relation to original plan. Forecasts for estimate of completion, estimate to complete, and to complete performance index can be used to estimate project schedule and cost performance outcomes.
Controlling the cost of production is one of the main objectives of business organization. It can be achieved by setting some standards to compare the actual outcome of business activities. It helps in minimizing the cost of production as there are limited resources available with the organization. Cost control as a management function refers to process that ensures if the course of action of management activities and operational decision coincide with the plans or the set standards. Standard costing, marginal costing, and budgetary costing are the tools, techniques which provide better and successful operations if implemented simultaneously in a proper manner. Standard costing and variance analysis. Standard cost is defined as a predetermined cost which is calculated from management standard of efficient operation and the relevant necessary expenditure. It may be used as a basic for price fixation and for cost control through variance analysis. Standard costing is defined as preparation and use of standard cost, the comparison with actual cost and analysis of various into the causes and points of incidences. From the definition given, the following features of standard cost and standard costing emerge. Setting of standard costing. Now we have to see the setting of standard cost for various elements of cost like material, labor, and overheads, and subsequently the computation and analysis of variances. The setting of standard cost is discussed in the following paragraphs. Direct material cost standard. Direct material is an important element of cost, and in several industries, the direct material cost is 50 to 55% of the total cost. The standard direct material cost indicates as to how much the material cost should have been, and then it is compared with the actual cost to find out the difference between the two. Direct labor. Labor is also an important element of cost, and the standard labor cost indicates the labor cost that should be incurred. Two factors are needed to be taken into consideration while fixing the standard labor cost. The first one is the standard time and the second one is the standard rate. Concept of standard hour is extremely important in setting the standards for labor. It is a hypothetical hour, which represents the amount of work which should be performed in 1 hour under standard conditions. Factory overhead standards. Setting off standard for overhead costs, there is a need to determine standard capacity and standard overhead costs for that capacity. The standard overhead costs can be computed using normal capacity. Normal capacity is not the total installed capacity, but it is the practical capacity which is based on the resources available and efficient utilization of the same. After this, the standard overheads are fixed. Direct expenses. If at all there are some items of standard expenses, rate per unit of the same may be determined on the basis of budgeted output and budgeted direct expenses. Computation of variances. Variance is the difference between the standard cost and the actual cost. In other words, it is the difference between what the cost should have been and what the actual cost is. Material variances. In the material variances, the main objective is to find out the difference between the standard cost of material used for actual production and actual cost of material used. Labor variances. Like the material variances, labor variances arise due to difference between the standard labor cost for actual production and the actual labor cost. Labor rate variance. One of the reasons for labor cost variance is the difference between the standard rate of wages and actual wages rate. Labor efficiency variance. It is of paramount importance that efficiency of labor is measured. For doing this, the actual time taken by the workers should be compared with the standard time allowed for the job. Labor yield variance. In this variance, a comparison is made between the actual production achieved and the production that should have been achieved in actual number of working hours. Idle time variance. This variance indicates a loss caused due to abnormal idle time. While fixing the standard time, normal idle time is taken into consideration. Overhead variances. The overhead variances show the difference between the standard overhead cost and the actual overhead cost. We will take up the fixed overhead variances first and then the variable overhead variances. Responsibility accounting.
We're going to look at the 5 different types of responsibility centers a manager could manage. And then if you're able to identify what type of center a manager can manage, then you know what they're responsible for, and then you can be more effective in your criticism or your evaluation of them. So the 5 include cost centers. Now a cost center is where you're making a product or providing a service, and the cost that you're accountable for, responsible for, can be traced directly to that product or service. So those are things like direct materials, direct labor, overhead. Those are the costs that are traceable to the product. So as a manager of a responsibility center, meaning a cost center, you should only be evaluated based upon how you spend those costs and compare that with your budget. Now, to do an effective job of comparing a cost center actual results with its budget, we're going to have a brand new kind of budget. It's called a flexible budget. And a flexible budget is prepared at the end of the year based on the actual output. So in other words, it says, what does this budget look like based upon what you actually produced? And then it's much more meaningful to compare actual results with that budget rather than that master budget you prepared before the year ever began. In the next chapter, we're going to spend a lot of time on cost centers using a performance evaluation measurement system known as standard costing. And we'll be able to break down that materials, labor, and variable overhead and fixed overhead into a lot of different variances, 8 variances in all. So that's next chapter. Discretionary cost centers means that you're a manager and all you're doing is spending money. You're not generating any revenue, but there is not a traceable result between your actions and the products or the services that the business sells. A discretionary cost center would be those support activities such as legal, such as HR, human resources, such as accounting. They're essential to the business, but do we try to minimize their costs? So in a discretionary cost center, we'll compare what they actually spent with their budget and probably use non-financial performance measures to see if these centers and their managers are effective in being responsible for their duties and doing a great job. So a lot of times non-financial performance measures. Did their project go okay? Did they reach the folks they wanted to reach? So that's discretionary. The next one is called a revenue center. And if you're a manager of a revenue center, that means that you are in charge of sales, in generating revenue. You don't have very many costs, but you need to drive that revenue. So how I would compare this is look at my budgeted sales forecast versus what you actually sold. So again, am I comparing back to a budgeted amount? Again, I would probably run a flexible budget so that I can see that if my sales exceeded expectations, that I also had the budget in order to meet those expectations. So a flexible budget is very helpful because it compares actual results with a budget as if it was prepared for those actual results. Revenue centers, you know about e-commerce. That's where you have a phone center and you call up and you place an order, or you're online and you place an order. Those are those order centers. Those are revenue centers. Profit centers means you're a manager of like a store and you have both revenue and cost responsibilities. A profit center might have revenue centers and cost centers underneath it. So a profit center has a bit more wider responsibility. A profit center is like a store. A great way to evaluate a profit center is through the income statement. And we could do a variable income statement, and that variable costing income statement looks just like a cost volume profit analysis income statement, except it's done at the end of the year. So profit centers. The final one is an investment center. Investment center managers probably have these other centers underneath them, and they have broader responsibilities. Not only are they responsible for day-to-day, but also policy decisions.
Responsibility accounting collects and reports planned and actual accounting information about the inputs and outputs of responsibility centers. The resources utilized in an organization are physical in nature, like quantities of materials consumed, hours of labor, etc. are called inputs. In a similar way, outputs are based on cost and revenue data. Responsibility centers. A responsibility center is a subunit of an organization under the control of a manager who is held responsible for the activities of that center. The responsibility centers are classified as follows. Cost centers. When the manager is held accountable only for costs incurred in a responsibility center, it is called a cost center. It is the inputs and not outputs that are measured in terms of money. In a cost center, it records only costs incurred by the center or unit or division, but the revenues earned are excluded from its purview. It means that a cost center is a segment whose financial performance is measured in terms of cost without taking into consideration its attainment in terms of output. Profit centers. When the manager is held responsible for both cost inputs and revenues output, it is called a profit center. In a profit center, both inputs and outputs are measured in terms of money. The difference between revenues and costs represent profit. The term revenue is used in a different sense altogether. According to generally accepted principles of accounting, revenues are recognized only when sales are made to external customers. For evaluating the performance of a profit center, the revenue represents a monetary measure of output arising from a profit center during a given period. Investment centers. When the manager is held responsible for costs and revenues as well as for the investment in assets, it is called an investment center. In an investment center, the performance is measured not by profits alone, but is related to investment effected. Quality costing. The term quality cost has different meanings to different people. Some equate quality cost with the cost of poor quality due to finding and correcting defective work. Others equate the term with the cost to attain good quality. The term quality cost means the cost of poor quality. Categories: cost of quality. Internal failure costs. Internal failure costs come from deficiencies discovered from delivery. These include all the costs associated with the failure, non-conformities to meet the needs of external and internal customers. Internal failure costs can be listed as follows. Scrap. The labor, material and overhead that created the defective product. The item cannot be economically repaired. Rework. The cost to correct the defective material or errors in service products. Loss or missing information. The cost to retrieve this expected information. Failure analysis. The cost analyzing non-conforming goods or services to determine the root causes. Retest. The cost to retest products after rework or other revision. External failure costs. External failure costs come from costs associated with defects that are found after the customer received the product or service. These costs included lost opportunities for sales revenue. Lost sales revenue costs would disappear if there were no deficiencies. Classification of external costs. Warranty charges. The costs involved in replacing or making repairs to products that are still within the warranty period. Complaint adjustment. The cost of investigation and adjustment of justified complaints from the defective product or installation. Return material. The dollars associated with the received and replacement of defective product received from the field. Allowances. The cost of concessions made to customers due to substandard products accepted by the customer. Penalties due to poor quality. This can apply to goods or services delivered late or too early. Rework on support operation. Correcting errors on building and other external processes. Appraisal cost. Appraisal costs are quality costs that determines the quality of a product. These costs are normally associated with inception. This includes inception on received, inception at the source or by surveillance. Prevention costs. When implementing and tracking a cost of quality system within a company, management typically focuses on internal and external failure cost. Cost of prevention focus on the action taken to prevent the creation of defects. These companies spend more on prevention methods than the other quality cost elements. Here are examples of these costs. Quality planning. This includes the broad array of activities which collectively create the overall quality plan and the numerous specialized plans. Process planning. Process capability studies, inception planning and other activities associated with the manufacturing and service processes. Standard cost variances. A variance can be either a price variance or a quantity variance. A price variance arises when the cost to purchase an item differs from its standard price. A quantity variance occurs when the number of units actually required to build a product varies from the amount specialized in the standard costing system. Variance analysis. Variance analysis can be defined as a process of computing the amount of and isolating the cost of variances between actual cost and standard cost. Variance analysis involves two phases: computing of individual variances and determination of the cost of each variance. Material usage quantity. The material quantity or usage variance results when actual quantities of raw materials used in production differ from standard quantities that should have been used to produce the output achieved. Causes of material usage variance: poor materials handling, inferior workmanship by machine operator, faulty equipment, cheaper, defective raw material and causing excessive scrap, inferior quantity control inception, pilferage, wastage due to inefficient production method. Labor variance. Labor standards are also established for both cost and quantity. For standard cost purpose, direct labor is treated separately from indirect labor, which is included in the factory overhead. Two standards are usually developed for labor cost: labor uses efficiency standard and labor cost rate standard. Causes of labor efficiency variance: machine breakdown, inferior raw materials, poor employee performance, inefficient production scheduling, new inexperienced employees, poor working condition, overhead variance. The analysis of factory overhead variances is more complex than variance analysis for direct materials and direct labor. Sales variance. It is the difference between the actual values of sales achieved in the given period and budgeted value of sales. Sales variance can be calculated by using any one of the following: sales variance based on turnover, sales variance based on margin. Setting standards. Normally, setting up standards is based on the past experience. The total standard cost includes direct materials, direct labor and overheads. The standards should be set up in a systematic way so that they are used as a tool for cost control. Setting standards for direct materials. There are several basic principles which ought to be appreciated in setting standards for direct materials. Generally, when we want to purchase some material, what are the factors we consider? If material is used for a product, it is known as direct material. On the other hand, if the material cost cannot be assigned to the manufacturing of the product, it will be called indirect material. Therefore, it involves two things: quality of material, price of the material. Setting direct labor costs. If we want to engage a labor force for manufacturing a product or a service for which we need to pay some amount, this is called wages. If the labor is engaged directly to produce the product, this is known as direct labor. The second largest amount of cost is of labor. The benefit derived from the workers can be assigned to a particular product or a process. If the wages paid to workers cannot be directly assigned to a particular product, these will be known as indirect wages. The time spent by different grades of workers for manufacturing a product should also be studied for deciding upon direct labor costs. The setting of standard for direct labor will be done basically on the following: standard labor time for producing, labor rate per hour. Standard labor time indicates the time taken by different categories of labor force, which are as under: skilled labor, semi-skilled labor, unskilled labor. Setting standards of overheads. The next important element comes under overheads. The very purpose of setting standard for overheads is to minimize the total cost. Standard overhead rates are computed by dividing overhead expenses by direct labor hours or units produced. The determination of overhead rate involves three things: determination of overheads, determination of labor hours or units manufactured, and calculating overheads rate. The overheads are classified into fixed overheads, variable overheads, and semi-variable overheads. There are several problems with variance analysis that keep many companies from using it. They are: time delay. The accounting staff compiles the variances at the end of the month before issuing the results to the management team. In a fast-paced environment, management needs the information much faster than once a month. Variance source information. Many of the reasons for variances are not located in the accounting records, so the accounting staff has to sort through such information as bills of material, labor routines, and overtime records to determine the causes of problems. Standard setting. Variance analysis is essentially a comparison of actual results to an arbitrary standard that may have been derived from political bargaining. Cost variance. Companies regularly analyze sales variances to explain revenue performance over a monthly, quarterly, or yearly accounting cycle. The resulting sales variance explanation helps firms isolate problems and gear their future sales and marketing efforts towards increased sales growth. Sales price and production variances. When reviewing past sales results, an analyst compare them to budgeted or estimated sales performance for the company. When results do not line up, the analyst must find a plausible and meaningful explanation. Variance in sales prices may also cause or contribute to variances, such as when a company needs to drop prices to sell enough volume to meet its budget goals. Product mix. Companies selling more than one type or style of product may experience sale variances stemming from an inaccurately projected product mix. Companies assemble budgets using different methods. If a revenue budget uses percentages to allocate budget expectation for revenue expected from various products, variances can occur if the business did not allocate the product mix effectively. Marketing programs. When companies invest money and effort in marketing programs, they have no guarantee of increased sales. As consumer preferences change, a previous year's marketing campaign may not bring the same product sales results, causing variances from a budget based on historical results. Market share. Firms have no control over the competition and may experience an unplanned decline in sales market share if competitors introduce strong marketing campaigns on new products. New competitors may also reduce an existing company's market share more. The company anticipates reducing the firm's sales and causing a budget variance. Economic conditions. Even when firms tailor budgets to account for changes in the economy, no business can accurately predict the effects of these changes all of the time. Economic unrest, especially for companies selling products or services that consumers do not consider a basic need, can cause volatile sales and larger than expected changes in sales performance. This may lead to sales variances against the company budget. Summary. Now in the end, let us summarize what we have learned in this lecture. Labor is also an important element of cost, and the standard labor cost indicates the labor cost that should be incurred. One of the reasons for labor cost variance is the difference between the standard rate of wages and actual wages rate. When implementing and tracking a cost of quality system within a company, management typically focuses on internal and external failure costs. The material quantity or uses variance result when actual quantities of raw material used in production differ from standard quantities that should have been used to produce the output achieved. When the manager is held accountable only for costs incurred in a responsibility center, it is called a cost center.